Let's broaden out the discussion on the economy and the Fed. My next guests have similar sounding names, but very different views on what the Fed should do right now. Joining me now is Richard Bernstein of Richard Bernstein Advisors and Brian Weinstein, who is head of global markets at Morgan Stanley Investment Management. It's great to see you both. Brian, let me just start with you because you think they better cut quickly or they're going to be behind.
Well, listen, Kelly, we've been on this show talking about this all year, and Steve just said it, right? We've been talking about 3 rate cuts. You keep pushing them back in. You're finally seeing evidence. We know inflation's gone down. We've got to change the story. Growth is slowing now. So the Fed needs to calibrate. They don't need to go from 5.5 to 3. They don't need to start a multi-100 basis point cycle, but they need to make sure they're showing the market that with lower inflation and lower growth, 5.5 is a little too high. They're going to start to come down, and I think they can do it. They won't do it in July. They probably should. The next 3 meetings seems very reasonable to me to calibrate Fed funds a little bit lower than it is today.
So, Rich, why doesn't that sound reasonable to you, especially September?
Well, Kelly, I think 2 things. Number one, you got to remember Wall Street. We're liquidity junkies, right? We can never have enough liquidity. And so every opportunity we get to suggest that the Fed should be cutting rates, we always say the Fed should be cutting rates. I mean, that's been the story now for a year plus. And so that's the backdrop. Number 2 is I think we have to step back and say, is the economy weakening enough for the Fed to really decide to cut rates here? Is there a scarcity of capital? Is lending starting to seize up? Right? What would be the impetus? Is the banking system weakening? Any of these things? You put that in contrast to the November election. Now, the Fed never really pays attention to the election, and rightly so. But in the absence of a truly weak economy, why would they stoke the issue of Fed independence prior to the election when they don't have to ease? There's nothing here saying that there's a dire need to ease.
Are we conflating, Rich, weak economy with needing to ease when they could just ease because of lower inflation? In other words, it's that same old thing that Williams has been talking about for a couple of years. If inflation comes down and you don't lower the policy rate, you're tightening.
Yeah, well, to some extent, that's absolutely right. But, if you look at some of the leading indicators that caused the inflation problems last year and the year before that, if you look at things like container rates, you will see container rates are skyrocketing right now. Supply chain disruptions are not over. In fact, they're coming back. And so you've got issues like that are suggesting what's the rush here?
Totally. Let me come back to this just with a new data point that Rick is going to bring us on the 7-year auction. We know it's been kind of a weird week for these. Rick Santelli's out at the CME where 7 years went up top of the hour. Rick, how'd it go?
Well, you know what? All that green in equities put all the investors in a pretty good mood because they really liked the 7-year auction. They were grabbing them like French pastries today. We're talking about $44 billion 7 years, completing $183 billion in coupon supply. The grade I gave it for demand at 1 Eastern, A-. If you look at all the internals, the bid to cover, the best since October of last year. The indirects, best since August of last year. The dealers took the smallest amount since June of last year. The only fly in the ointment was a bit light on direct bidders, the pension funds, the insurance entities. But those entities really rather have 10s and 30s, the longest maturities, to match up better with their long-term liabilities. But it really was a good auction. I think yesterday's auction was weak based on the equity markets putting a bit of fear inside the investors. Today it was the exact opposite. 7 years always a bit of an oddity on the yield curve. It's slowly starting to build enough pool of liquidity to be taken seriously, but it was a very good auction, and it underscores the give and take in the marketplace from the change in the equity perspective in 24 hours. The yield curve is still the least inverted it's been in a while, but you are seeing a flipping where the 2-year is closer to unchanged and the longer maturities have a little bit more buying, pushing their yields down. The exact opposite of yesterday with a lot less intensity. Back to you.
I was going to say the exact same thing. I'm watching the 30-year. Like you said, Rick, keep an eye out. It's unwinding much of that move. Rick, thank you, Rick Santelli. Brian, I was going to ask you about that. Actually, I wanted to talk to you to say what's going on with the yield curve. Why the steepening? Is it the yen? Is it Dudley? And now even as I'm asking the question, it's starting to unwind some of that move from yesterday.
Yeah, listen, I think Richard is onto something, right? We are liquidity junkies. So the Fed's going to ease once and all of a sudden they're going to be at 3.5% at the end of next year. Like, no, that's too much. We're just calibrating, Kelly. I think you said it well. So what's happening with the yield curve is I think what happens when we know the Fed is going to go. So I do think they go in September. And then you throw in uncertainty, right? I mean, listen, does 25 basis points of the Fed matter amongst the political shenanigans that we're seeing and all the uncertainty there? I don't think so. So I think the Fed has a path to ease. We know the fiscal story. We know it's getting worse. We know the candidates aren't going to stop spending. And so you start to put election trades into play. I think it's very hard to play 230 steepeners from here. The front end can't rally a lot. We're priced for a lot of easing, but I do think it's easy not to own the long end when you have the uncertainty, more easing, inflation likely to tick up. Again, the container ship pricing, you do see signs that inflation is not going back to 1.5. So if the Fed's not going to 3.5, the back end can't rally a ton more, nor can the front end. So I think we've done the right thing. It'll be harder from here. Yeah. And again, I still just don't like the long end of the yield curve. I think it's the wrong place to be.